What's up, guys? I recently posted a schematic on buying pullbacks, specifically wave one pullbacks, using a method called the 1, 2, 3, 4 method. And basically, what that entails is separating your order into four different positions, weighted in that fashion. So if you've got $1,000 position, you're going to have four entries. Your first one is going to be $100. Your second one, two, is going to be 200, three, 300, and four, 400. And that obviously that equals $1,000. And you can do that with anything. It's just basically, anything divisible by 10. That's the way you would do it. And the way I target entries and exits using this method is with Fibonacci. Typical retail behavior. They see a major pump happen. They get all excited. They market order in at the top, and they end up getting flushed out before the actual move takes place. That initial move is often retraced. If we're talking a wave one, a lot of the times that's to the 618, to the 786. And in crypto, you get a lot of 886s. So there's a way I use to enter after that move's already taken place. I don't have to forecast. I don't have to predict. I don't have to, I don't have to do anything except for let the move take place and then react afterwards. I'm going to pull up my chart here. Doge is a good example of this. So let's start right here. You've got this initial move up. Right, everyone's excited. Oh my God, Doge to the moon. It's never coming down again, and then it comes down. But if we wait, let this move happen, we get to the top here, we get this initial high, then you start getting these wicks. We make ourselves a little zone here. All right, you got your little zone, and you broke underneath it. You broke your trend, your parabolic log curve coming up. So retail probably FOMO'd here. FOMO'd here. It's going to the moon, never going to stop. And what the method I'm talking about here would do is we'd wait for the top to develop. We'd wait, and then we would take our fib tool, and we would just simply buy the retracement levels. If we're looking for a wave one, chances are, like I said, they usually come down to the 786 or the 886. But you could start this at any level you want, right? If we're doing four entry positions, let's say we start at 382 and then layer down to the 786. So basically what you'd be doing is be buying $100 here, right? $100 here. We're going to buy $200 here. We are going to buy 300 and then 400, right? And then ultimately we have a $1,000 position now at this level. Now you could do this two different ways depending on your risk tolerance. You could set your stop loss under the 886, but it is crypto. The 886 gets hit sometimes. Realistically, if this is a new wave up, you're invalidation is going to be underneath it. So obviously you're going to have to do a little bit of math to understand what your overall risk is. But if you were going to enter with $1,000 anyway, the lower you enter, the better the odds are that you are not only getting a discount, a deep discount price on an asset that you already know is moving up, and your lowest risk is going to be up here. So sometimes, maybe this never goes lower than the 382 or the 50% retracement, and it just goes on. Well, if that's your worst complaint, that hey, I made money but I didn't make all the money, well, then you move on to the next trade. If you're making money and that's your complaint, it could be worse. You could be losing money. Because if you bought everything at the 382 and you get stopped out, well, now you didn't make any money. So this is a way of mathematically putting statistics on your side, because if an asset's already in an uptrend, you would assume that it's going to continue the uptrend, and the lower you buy, again, that is less risk. If you're going to get stopped out down here, the lower you buy is less risk, and it's proportionately in your favor. If you get $100 entered here and you get stopped out, it's a lot better than having everything entered and then you get stopped out. So that's one part of it. And another thing you could use this method is if you are taking profits. I'm just going to set that to this. Now, if we were taking profits on the extension of this correction, you'd do that in the same way, just to the upside. And you could use Fibonacci targets if you wanted to. Depending on, if this is a wave one, we're expecting a continuation to at least the 1618 of not only the correction, but of the full move. And if you look, the full move, the extension, moving awfully slow. You get the idea. And you just separate your exits in the same way. Now, I'm on low time frames here. You can use this same method on a macro time frame, for bull market targets, for any way you want, as long as you identify a wave that has taken place and has ended. And if you were paying attention to Doge and you were trying to ride and capitalize the most of this move, well, look how many times you could have done this, right? You got your move up, you got your retracement. Now we're selling into our extension levels. 1618 would always be the target minimum for an impulsive wave. But let's say, hey, we've got this wave, we bought our pullback, we sold our extension. Now we've got this second one, and what we are going to do is we got our second one. Let's do the same thing. Now you're looking at doing the same thing. And in this case, you see that 886 did get hit, but what did not happen is your invalidation did not get hit. So you were able to say, hey, maybe this time you don't want to buy the 382. If most of the time a pullback goes deeper than the 382. Well, let's see if we can start pulling the 886. And then the same thing. You'd say, okay, we've got our pullback. We bought our pullback. Now let's get our extension. And in this case, it hasn't hit the 6-1 or the 1618 yet. But if we were layering out, well, it actually did hit the 1618 of the previous one. But if we were talking an extension of this correction, you could say 113, 1272, and you know, maybe you don't know if it's going to extend. Maybe I want to unload at the 618 a little bit, I want to unload at the 886 a little bit, and then I want to unload at the 1272 and the 113. You know, you could do it in that fashion. So if we get rid of that, we said, all right, we bought our pullback using this method, and now we're going to sell into, and you know, there's a reason that maybe you want to do it this way, because this was a very deep correction. But again, now you're taking your $1,000, you're selling 100 here, 200 here, 300 here, and then 400 at the 171 or 1272. Again, now you're out. You got most of this move. Not only did you buy at the absolute low, or you know, percentage wise, most of your position was at the very bottom. That nobody could have just traded this looking at the chart, having a plan. Just market buying into this, you're going to miss it. A lot of the times you get these small wicks down at the bottom that, you know, only people who were prepared for this are going to get. People with limit orders already set up. And again, not to beat a dead horse, but look, we've got our move up. Let's take our fib retracement. And now, same thing. If we were going to buy from the 50%, the 618, the 786, and the 886, it's the same story over and over and over again. And again, this isn't, there's no prediction. There's no, you know, crazy technical analysis that has to be done here. You just wait for the move to happen, set your limits in the retracement. Maybe they get hit, maybe they get filled, maybe they don't, but your risk is so much lower. The statistics are on your side, and if it ends up being a failing trade, maybe it does make a lower low, which again, the invalidation would have been down here. That would have been your stop loss underneath that. Maybe you do get stopped out. Again, most of your risk is right by your stop. And again, a lot of these levels, especially when you get into the deep retracements, are not easy to just manually, okay, I happen to look at the chart when Doge is right at the 886 for 10 seconds and I ordered in. I set up an order. A lot of the times that's never going to happen like that. Setting up your limit orders ahead of time is very, very useful. And again, you do also have to understand what trend you're in. If you're in an uptrend, especially if you reference a higher time frame, say I'm in an uptrend on the 4 hour, so I know my bias is going to be up. I'm on the 30-minute setting these limit orders. Well, now that puts the odds of my favor in my favor for the trend continuing. If I'm buying dips in an uptrend, the odds are in my favor that it's going to continue until it doesn't, and you know, you'll take a loss if that happens. This isn't this doesn't change your odds of whether or not price is going to go up or it's going to go down. But again, it's using these levels for risk management. All your risk is right down by your stop loss, and when you do get a winner, then the winner is going to be, it's going to have a lot more to travel just into retracement levels from the bottom, even if it doesn't make a new high. You don't have to shoot for extension levels. You could shoot for retracement levels. So rather than looking for the extension above the high, you could just say, hey, I don't really want to, I don't want to shoot for those type of retracements. What I want to do is I just want to sell into a common retracement level. So you could do, instead of the extension, you could say, hey, I bought my orders on the retracement. Now I'm going to sell my orders also on the retracement. And yes, price might end up making a new high, but because you bought the lows, this is a very equitable trade just to sell the retracements. And let's say we set it up like this. Now we're going to sell. Oh, shoot. I got them upside down. And same thing goes with this. Now you're selling. You probably could do this the opposite, the way I just had it before. And statistically, maybe that might be more profitable. Maybe that's something you would want to look into if you decide to use a strategy like this. Maybe you want to sell the most lower. Maybe you want to get the chunk of your position out because you don't know if it's going to come up to the 786. And waiting with most of your position not closed out, maybe that would change the odds against you. But that's something, it's up to your risk tolerance. But this would be the same way, because what could happen is you could end up getting something like this. Okay, now you get a continuation. So rather than being stopped out, now, hey, you got most of your position out, and you see the rejection. Maybe some bearish variables have presented themselves as you're coming into these retracement levels. Maybe you got, maybe you got some divergence here, and you're like, all right, I'm just going to close out the rest of my position. Most of it already got taken out with my limit orders. And you could do this blindly because the mathematical odds are going to be on your side. If you're buying deep value levels and you're selling retracement levels or deep value or extensions, the bigger piece of the pie is always going to be the reward over the risk. And that brings me to another real easy way of keeping the odds on your side, and that's trading 3 to 1. Why am I having a brain fart? Okay, so you've got trading 3 to 1 means that you have 3 times as much reward in your trade than you do risk. And you could trade any multiplier, but the idea of having your reward weighted heavier than your risk is because if you flipped a coin and you took a trade, you're going to get 50% right, 50% wrong in the long run. Price is going to go up, price is going to go down. Over time, you're probably going to average about 50%. Well, if you won half your trades and you lost half your trades, and each time you won or lost the same amount of money, you're going to break even. Or maybe you'll lose. Maybe you'll be in a losing position. So with a 3-to-1 trade, I can take 4 trades. Say every trade I'm risking $100. And if I win, I get $100, and if I lose, I'm minus $100. So if we do this 3 times, oops. Why can I not select my text? All right, let's try this again. 3 trades, they're all 3-to-1, and well, you lost the first one. You lost the second one. And this is 1-to-1 trading. So if you were trading 1-to-1 and you lose 2 and you win 1, you're down $100, right? In 3-to-1 trading, we'll say instead of all right, let's try this again. All right, so same thing. You lost the first 2 trades with 3-to-1 trading, but you won the last one. So now you're down 200 and you're up 300, meaning you're up $100. Same, same trades, except you're using a different risk to reward. Now, say you took 4 trades and you lost the first 3, but you won the third or the fourth one. Now with 3-to-1 trading, you are down 300, but you won 1, so you're up 300, which means you break even. You can lose 3 out of 4 times and not lose money with this style of trading. Obviously, it's you're gonna have little things that might affect the overall picture, but the idea is the same. You're putting mathematics on your side to make it more probable that you're going to win money. Now, obviously, if you just have arbitrary take profits, arbitrary stop loss levels, no rhyme or reason, and you're just flipping a coin, that would be the idea. But if you're applying technical analysis, or if you're trading from levels that are more probable to be reversal levels, or anything else, whether you're using momentum oscillators, whether you're using whatever it is, if you're adding an additional layer of an edge to your trade, and you're also trading like this, even what we were talking about before with layering in a certain way and still taking the 3-to-1 trades, now the odds are monumentally on your side. I think that's a phrase, right? They're on your side. Okay. Now, if you were doing the same style, 3-to-1 on every one of these trades, except now, well, I'm gonna lose half of these trades. Oops. If you're shooting 50-50, flipping a coin, trading 3-to-1 out of 4 trades, hypothetically, you'd be down 200, and now you'd be up 600. So you're up $400, even though you lose half the time. And again, you combine this with other things, it's it's all about statistics, probabilities. You want to put the odds in your favor. If you're buying stuff that's at a discount using pullback methods like I showed you, that's going to help. That's going to put the odds in your favor. If you're buying with the trend, if you're buying, dips in an uptrend, if you're selling pops in a downtrend, that's also going to put statistics in your favor. If you're trading patterns, harmonics, if you're using whatever kind of method, you want to use all of these things in combination. Say you won 3 out of 4 trades. You see what I mean? It's now you're at 900 minus $100. It's 800, and you could trade 4 to 1 if you wanted. But you'll realize that once you the higher risk to reward you go, the more reward with less risk. Obviously, they're going to have a lower hit rate. But what you can do also using this same method here, maybe you're not sure where you want to set your stop loss. Maybe you're not sure where you want to take your profit. That's where you can use this schematic. And the other way, say we took our trade at the 886 with our 3 to 1, and we're like, all right, we want to take a conservative move to even the 382. We know where we want to go. We know where this trade, where the take profit's going to be. You can use the 3 to 1 metric to now place your stop loss. Realistically, you should be doing that in the other direction. You want your stop loss to be somewhere that makes sense, but I'll get to that in a second. So let's say, all right, our target's the 382. We want to risk 3 to 1, which in this case that would actually work out because your stop loss would be under the last low, and you still get a 3 to 1 trade. But what you could do in a different circumstance is say, hey, what I want to do is I want my stop loss to be the first thing I'm thinking about. I want to know what my risk is. Take profit, whatever. The risk is more important. It's more important to not lose money than to make money over time. So I'm going to set my stop loss first, and now I'm going to take my take profit where it makes sense, using the 3 to 1. So say, just for the sake of this working in that fashion, I'm going to say we're going for 4 to 1. What I would do is I just move my take profit to a 4 to 1 trade, and a 4 to 1 trade is still within retracement levels. It's right at the 50% just about. So this wouldn't be a weird thing, or a weird target to shoot for. Now, if you're good at identifying levels, the levels are going to be important. This is just a basic way of setting up your risk to reward ratios. And the same thing goes, I guess one more layer we could put onto all of this is, say you are buying, instead of buying the retracements after this has happened, say you want to trade differently. You don't know if this is the top yet, right? You don't know if there's going to be another high. You don't know if there's going to be a double top. But you want to buy the retracement. So what we're going to do is when you get your first move off of a top like that, you know, one that undercuts the previous lows, that would, well, one way of identifying that a correction is taking place is if you retrace deeper than the 286 or the 236, right? So once price cracks underneath the 236 on this move up, you know that this is going to be a correction. So what you could do is say, hey, instead of just guessing, you know, just throwing out limit orders at the 786 or the 886, what you can do is you can buy the extension of the correction. You say, hey, yes, it made a move down, but I think it's going to go lower. But at this point, the only information I have is this move down. Well, I don't want to buy, you know, the retracements level, the retracement levels of this wave, and I don't know which levels I want to buy of the retracement levels of this wave. So what you're going to do is go to extension levels, and the only information you have is the first wave down. And in this case, you can't see it, but you would, you know, set up your limits the same way we were talking about earlier. Is right. So in this case, all your targets didn't get hit to the downside. If you were trying to get that 1618 extension, you didn't get it. But you got your 113, you got your 1272, or what you could do a lot of times is rather than take the extension of this wave, you take the extension of the wave that came before it, which in this case, you know, whether you're looking right here or down to this wick, if we go down to that wick and here, you still missed it. So I guess that didn't really help my explanation. It was a really shallow pullback. A lot of the times you will. But the idea is you are taking fib extensions and fib retracements, and what you're doing is you are targeting the deeper part of a retracement or the deeper part of an extension, because again, it's putting you at odds that you are closest to the pivot, closest to where that price is going to move. And if you're using proper risk management, same position size on every position you're taking. And one thing I like to do, I mean, it's not something you have to do, is I like setting up all of these ahead of time. See, I've got my extension fib with all my levels already built in, and then I've got, and you can save them in TradingView in the templates. Now I've got my corrective fib. This is automatically just puts in the 382, the 50%, and the 618, or one that has in the 50, the 618, the 786, and the 886. You know, just whatever levels that you are going to be using the most. You know, you set up little templates so you don't have to spend time, you know, choosing these things. I have a bunch of these pre-saved so I can instantly just say, hey, I'm looking for a pullback. This will give me my levels. You know, if this pullback got invalidated and it made a new low, well, now I'm going to be looking for the 1618 extension. If I get stopped out here, now I'm going to be coming down here. And what you could do is say, hey, I think a new low is going to come in. What I'm going to do is, instead of just maybe getting filled at the 1618, I'm going to take my fib and I'm going to do the same thing and say, hey, I'm now dividing this level up with my fibs, and I'm going to set my levels up the same way I had them before. I'm going to buy the 382, the 50%, the 618, and the 786, and have it split up inside of this zone. Or you could do it, you could do it, say you wanted to buy deeper. Say, hey, maybe I don't want to risk not getting hit at not getting filled at this 1618. I'm going to shoot for these 4 levels, close down to it, deep down to it, and then have my stop loss, marginally below the 1618. Because if you're expecting the 1618 to get hit, obviously you're going to want your stop loss lower. Or maybe you could set it up, say, buy the 618, buy the 786, buy the 886, and then buy your actual target with, again, the heaviest weighted position being all the way down here. So if you end up getting stopped out, if it just blows right through you, at least you're doing it with the least amount of risk. There was more to this that I wanted to talk about. It kind of brings it a little bit deeper. But I can't think of it. So if you guys got any questions about this, I'm going to make a lot more of these videos. Try to get some of this stuff up and out. Maybe you guys can help me understand what part of this you want to know more about. Maybe different topics you guys want me to talk about, or things that I've discussed on Twitter or in the Discord, which if you're not a part of, you're messing up, because we got a lot of good information in there, a lot of good trade ideas. All of my indicators that I use on my charts are custom indicators. Everything's all in there, all in one place. Just joining the Discord as a community member is free. You don't owe me anything. We do have a Patreon if you did want to get access to my charts, trade ideas, all the indicators, but just joining's free. That's for everybody. In the description there is a link to do so. And yeah, if there's anything else you guys want me to do a video on, by all means, leave some comments, like, subscribe, do all that stuff. Tell me if you think I'm an idiot, tell me if this stuff helped. And eventually I'm going to compile all this stuff into a better organized version of all this that really dials in my particular trading style, my strategies, all the stuff I'm doing with these indicators. But we got to start somewhere, and I want to get some of this stuff out to you guys. So gonna have to deal with me saying a million times and losing focus. And that's it. All right, guys. See ya.